What's the response to this crisis? The first response is that the principle that certain institutions are simply too big to fail is made very explicit. Here we go back to Continental Illinois in 1984. The same principles that the Federal Reserve applied in that case become applied to every large U.S. banks. And there are two aspects. Stockholders are going to be allowed to lose. This is not a story of protecting stockholders. This is a story of anybody who has a fixed claim against one of these large financial institutions, whether it's an uninsured depositor or any uninsured creditor, they're going to be made completely whole. Do not ask me to explain this fetish that central bankers have with fixed claims as opposed to equity claims. It is a fact of life in this world. When they intervene precisely to prevent losses to unsecured or explicitly uninsured creditors. And the principle of institutions being too big to fail in this sense is extended selectively. Some investment banks, not all as we know, one big one, Lehman Brothers, is allowed to go bankrupt, but all the others are rescued on similar terms. Stockholders bear some losses, including complete losses, but the bondholders and depositors do not bear any. The largest insurance company in the world is moved into this category on the same terms. The so-called money market funds, which are basically mutual funds that hold short-term paper, there was something like a bank run on them because they weren't explicitly insured. Very quickly, they come under this regime. There's more, but I'm not going to go into the details. So here's an interim summary of the story. The government wanted to reduce our financial risks by insuring against losses on deposits. It created an incentive for offsetting behavior. Banks took greater portfolio risk. That's the first so-called Peltzman effect. The government tries to offset the offset by increased capital regulation and by adopting the so-called Basel rules on risk weighting. But the tougher regulation creates incentives for further offsetting behavior. And that increased the risk off of the regulated balance sheets. That you can think of the shadow banking system as the second Peltzman effect. But let me talk a little bit about Israel. I mean, I'm here in the Haaretz, so let me talk a little bit about Israel, where you haven't had much effect, you know, Baruch Hashem, right? Now this is you avoided trouble that affected roughly, and don't get into details with me, roughly similarly regulated banking systems, British banking systems, the Northern European banking systems, and not that regulated much differently than yours. There are always differences in detail, and you avoided their problems. But there are others like Canada and Australia which fit into the same boat. If there's a common pattern here, it's you didn't have exposure to either U.S. subprime mortgages or a local housing price boom. Now, people tell me there is now a local housing price boom. I should say, you know, be careful. Israel is not exempt from all of the incentives that I've been discussing, nor is it exempt from the results. And I'll give you a couple of examples. Go back to the bank share crisis here in 1983. What happened? Some of you are very young. You might not know this history. Bank share prices were being supported by the banks themselves. The scheme collapsed, and it threatened the stability of the banking system. There was substantial, in fact, on the books, complete losses to the stockholders, and there was a questioning of the stability of the banking system. What happened? The government ends up owning all of the banks and absorbing a majority of the direct loss. in official history here, this is played as a great scandal. All right? But think about the background. How different is this really from the subprime crisis in the United States? Here comes the answer to Daphne's question. Both served a social policy. In the case of the United States, there was a social policy to encourage cheap mortgages for lower-income people. In the case of the Israeli banks, the social policy had to do with inflationary finance. The bank balance sheets were expanding at double-digit rates in this era because you had inflationary finance. The capacity of the banks to absorb government debt was a good thing, so they encouraged policies which allowed the banks to raise capital. And what was the policy? It was a high-risk strategy that works if, in the U.S. case, the market value of houses doesn't start to go down. And in the Israeli case, if the underlying value of the banks also doesn't go down. To me, it's all very, very similar. If those things start to happen, then the scheme very quickly collapses, and it results in a government bailout. Now, you don't have explicit deposit insurance, but everybody knew that the government would make good on the deposits. It went beyond that, and again, for its own good or bad reasons, it also, unlike the U.S. case, it softened the blow to also the equity holders, which was a lot of, I won't go into the detail. There was a bailout, and let's just say it wasn't entirely unexpected. Another example, the kibbutz loan losses of the late 1980s. Right? Lending is increasing substantially to the kibbutz sector as they transition from agriculture to industry. Bank leverage is also increasing in this period. The risks are hidden. You know, they sound familiar. If I loan money to one kibbutz, it's risky. But if that's the banks insisted on cross guarantees because that made the assets safer. The business model of the kibbutzim depended on continued inflation. And then there's a macro stabilization which eliminates or reduces the inflation rate overnight, and a lot of these loans go bad overnight. Some banks are effectively wiped out. The effects are suppressed. How are they suppressed? The government owns the banks by this period, and it absorbs enough of the loss to avoid a crisis. So you didn't have a crisis. You had a crisis in waiting, and it was diffused by an injection of government cash. How is this different in principle from the subprime crisis? Not at all, as far as I can see. Let me address the issue of where do we go from here. I'll try to be a little bit quicker if I can. First, some basic principles. Before we know where we're going to go, we have to know what kind of a road are we going to travel. I think the lesson you can draw from this brief history is we should not expect to eliminate financial crises. That they're going to happen. We don't know how, when, where the next one will arrive. What we can do is try to reduce the incentives for the behavior that leads to a crisis and the costs of the crisis for the non-financial sector, including the taxpayers. That's what we can hope to do. And we can think in general of two kinds of policies. One I've talked about extensively, which is regulation. The other is deterrence. I haven't talked too much about that. Let's start with regulation, and then we'll go on to deterrence. Regulation, is, as you've seen in this history, is an attempt to suppress the incentive for risk-taking, which is always there. I have to keep insisting on that. So far, that's been the main response. And it's a work in progress. It's a work in progress in part because of the current administration's response, which is to let Congress handle it without any strong leadership from the executive. And Congress predictably wrote a 2,000-page law which said, we'll leave it up to the regulators. So we don't know where this law is going, but it's surely going to include another increase in capital ratios. Again, we're going to have this is going to be an international process. It's called the Basel process because the central bankers meet at the Bank for International Settlements in Basel to try to come to some agreement on where they're all going to go. It's kind of like a cartel of central bankers. And the Basel III, that's the response to the crisis, is that the minimum capital ratio, which you saw the actual ratio in the U.S. is in the 9% range. It's not too different in Israel. It's in the high single digits. Eventually, the minimum is going to be 10, not right away, but eventually. Maybe more in the UK and Switzerland. There's a lot of pressure from the government side to go above the Basel minimums. It probably is going to include activity limitations. The U.S. has adopted what's called the Volcker rule, which is to try to separate a risky activity, trading, from deposit and lending. That's one possible response. There's a report just released in the UK which is trying to go further than this. Again, the devil is often in the details, but there's clearly on the horizon certain activity limitations. Those special investment vehicles, that kind of thing is going to probably be restricted. Banks are going to be forced to keep more of their activities on the books. There might even be size limitations. One response, this is more the UK kind of response than it is in the US, say, well, these banks, what got us into trouble? These huge financial institutions which had to be bailed out because they're too big to be allowed to fail. Well, let's chop them up so they'll be small enough to fail. I think this is not going anywhere, but that's a possible response. History suggests you ought to be skeptical about all of this. You ought to be skeptical about the bottom line. Is this really going to make the system safer? Unless there's also more of the second kind of response, which is deterrence. Well, what's deterrence? Look at this picture. Here's a picture of two kinds of drivers, like two kinds of banks, A and B. A is relying entirely on regulation to be safe. B has nothing of this, but there's a deterrence to risky behavior. That's what deterrence is in general. How does it apply here? In particular, how do you say to the banks, do what you want, but if something bad happens, it's going to be bad for you? How do you do it credibly? You can do it, but how do you do it credibly? History, I'm afraid, suggests skepticism that it can be done credibly with the current mindset of the regulatory establishment. Past attempts to inculcate deterrence turn out to be ignored when convenient. So that law in the late 1990s in response to the savings and loan crisis said if you approach a 2% capital ratio, you have to take prompt corrective action. And when you hit 2%, we're not going to wait for the last 2%. You're going to be closed down right away. That's the deterrent part of the fiduciary law. As we know, it was ignored. Do you think that on any realistic basis, the largest banks in the U.S., except for possibly J.P. Morgan, but Bank of America, Citibank, you think they actually had 2% cushion against decline in assets? Absolutely no. But it was just ignored for them. Not for small banks. Small bank hits 2%, it's closed down right away, but not the Bank of America, not Citibank, and not any of the others that got into trouble that were big enough. Now, the new law that we've just passed has deterrence provisions. There's supposed to be an orderly liquidation authority, an institution which is charged with, when one of these banks actually gets to 0 or 2% or whatever the trigger is, instead of having a chaotic bailout, they're going to have an orderly liquidation. There's a principle that says we're not going to have bailouts anymore. And if somehow we do, the taxpayers are going to be repaid before the bank creditors. The bank creditors are going to have to take what's known as a haircut if they're not explicitly insured 100%. That haircut proposal is in the Vickers report, which was released just last month. It's in the U.S. law, too. But do you believe this? I don't. And more importantly, the market doesn't and shouldn't. Every crisis that has threatened the creditors of large banks in the past and has led to an extra-legal government intervention has not done any of this. So how can you believe that they'll do it now, just because it's written? It's happened in the U.S. several times since 1980. It's happened in at least the countries that I've mentioned, including this one. You didn't have orderly liquidation of Bank Hapoalim. Come on. That's unthinkable. Moreover, this credibility issue is worse today. The government extended the too big to fail principle beyond the big banks, quite clearly. Any big financial institution, in fact, it's official. The U.S. law now created a new regulatory agency. For what? For systemically important financial institutions. Well, what does that mean? Citibank and Bank of America are now officially systemically important. It means that they're officially too big to fail. Right? That's what it has to mean. And it will give them an advantage in securing funds. If you're a chief financial officer of a large business and you're looking to place $1 billion, are you going to put it into a systemically unimportant institution which will be allowed to fail? Or are you going to put it in Citibank, which is basically there's a 100% government guarantee for your deposits? It may have competitive effects, maybe, and certainly will reduce the sensitivity of their funding costs to risk. So they're being handed a heightened incentive to take risks. So in summary, what have we had? And I'm going to try to move rapidly here. We've had financial regulation is likely to continue promoting excessive risk, either by explicit or implicit guarantees. It creates an incentive to increase balance sheet risk. That's the first Peltzman effect. It responds to the increased risk mainly with more regulation, which increases the incentive to hide stuff from regulators. That's the second Peltzman effect. And unless there are expectations of substantial loss to creditors that become credible, both of these incentives will remain. Let me conclude with the Einstein effect, which I think is much more important than the Peltzman effect. So the government has tried to protect us from financial risk. That's where the story starts. Every attempt to do that so far has created incentives for offsetting behavior, which has made the system increasingly risky, to which the government has responded with more risk regulation. What's the Einstein effect? This is Einstein's definition of insanity. It applies completely in this case. So then that's the takeaway from this talk. So thank you. I'm sorry I've run a few minutes over, but